The International Monetary Fund, or IMF, is an international organization in the United Nations system. It was created back in 1944 to provide struggling countries with policy advice and medium-term loans. The IMF also publishes a World Economic Outlook report where the economists analyze global developments like the COVID-19 pandemic and try to predict near and medium-term effects on the world economy. Today, I wanted to go through the latest report by the IMF and its predictions on the outlook of the world economy in 2020 and 2021. The IMF points out three distinctions between this economic downturn caused by the COVID-19 virus versus other crises. The first is the scale of the crisis. Although some people dismiss the COVID-19 outbreak in China as nothing more serious than the flu in the beginning, it's been declared as a pandemic and the virus is on every continent in the world. As such, the virus is wreaking havoc on the world economy. Number two, the second difference is there is uncertainty on how long this virus will last. How long will it take for us to get a vaccine to all the countries affected? Will the number of cases go up again when businesses try to open their doors once again? These unanswered questions will play a critical role in the duration of this crisis. Number three is economic policy's role will be different. In previous economic downturns, governments and policymakers could try to spur on economic activity by trying to stimulate demand as quickly as possible. But the crisis is caused largely by containment measures. So, for example, lowering interest rates can help boost economic activity because borrowing money can be done more affordably. So people will be encouraged to go out and buy a house or a car or whatever they want at a low interest rate. And that's what the Fed's been doing. The federal funds rate has hit a historical low of 0.25. But it's different this time because it's not just that people won't spend money, it's that people can't. With so many businesses closed and millions unemployed, simply lowering the interest rate won't make the economy return to normalcy. As a result, the IMF predicts that the Great Lockdown will surpass the recession from a decade ago and that we will experience its worst recession since the Great Depression. Even after a decade after the 2008 recession started, it was reported in 2018 that half of Americans have not recovered from the last recession, despite the record low unemployment rates and the stock market hitting all-time highs. And at a time when not everyone has recovered from the last crisis, we are hit with a much bigger and stronger headwind. On the bright side of things, the IMF does project a partial recovery for 2021, although the level of GDP is expected to be lower than pre-crisis levels, with the projections being pulled -6.3% from the January projections for the year 2020 to -3%, and with a sharp rebound in 2021 to 5.8%. Now, this projection has a few assumptions. It first assumes that containment measures are effective and does not get delayed over to the second half of 2020. So, the first path to recovery is containment through mandatory lockdowns and social distancing to give the healthcare industry more time to handle the large spike in demand for their services. Healthcare spending should be increased to ensure that healthcare systems have enough resources to go around, and policymakers are required to do their part in keeping the rest of the population afloat during a time of mass closings of business to give everyone a chance at recovery once the first lockdown phase is complete. Another important step that needs to be taken is for countries to cooperate financially. That's the reason why the US Federal Reserve has been sending billions of dollars to banks all around the world by setting up what are called swap lines. It's essentially an agreement between one country's bank with another country to exchange their currency at the going exchange rate. Now, you may ask, why are we sending money abroad when we are forced to print tons of money to support our own economy from collapsing? And that's because a lot of international trade and transactions are usually done using dollars. Central banks in other countries need the dollar to stabilize their financial system from collapsing. And this benefits America as well because America trades with a lot of these other countries. So if these smaller and more vulnerable countries were to collapse, America would lose some of its trade partners as well. Now let's talk commodities. Using their baseline assumption that 1. The pandemic will fade in the second half of 2020, and 2. That the virus will spread to most countries and they will experience disruption in economic activity, the IMF predicts a general downward trend of commodities. Due to international and domestic travel restrictions, as well as a large reduction in oil traffic, oil prices accelerated downwards from their high of 57.60 in August 2019 to $32.30 in March. Average petroleum spot prices per barrel are estimated at $34.80 in 2020 and is projected to rise to $36.40 in 2021. As for metals, the mass shutdowns of factories first in China, which accounts for about half of global major metals consumption, and throughout Europe and United States has dragged down base metal prices almost 10% just in March. The annual base metal index is expected to fall by 10.2% in 2020 and another 4.2% by 2021 as a result of falling demand caused by slowing global industrial activity. As for food, food prices have generally fared better than oils and metals due to stockpiling reducing the blow to the industry. But lower oil prices also drag down prices of palm oil, soy oil, sugar, and corn. Overall, food prices are projected to fall by 2.6% in 2020 and rise 0.4% in 2021 with the base assumptions. Aside from the baseline assumptions, the IMF also provided a brief projection on more worst-case scenarios. The first scenario that is considered is if the outbreak takes 50% longer than the baseline assumption. In advanced economies, if the pandemic does not abate by the latter half of 2020, monetary policy will be used to lessen the blow to the economy and prevent risk premiums from going up. But even with the fiscal policy in 2021, there will be long-term damage to the economy through temporary slowing productivity growth and a temporary increase in unemployment. About 1% of capital stock is assumed to be lost through bankruptcies, only in advanced economies. These effects are expected to be 50% worse in emerging market economies, and global output is expected to be 3% lower than in the baseline case. The second scenario assumes another outbreak happening in 2021. The IMF puts it simply for the second case. Everything from case 1 will be 2 times exacerbated if there's another outbreak in 2021. The third scenario combines the worst cases of cases 1 and 2. If the pandemic does not get better by the latter half of 2020, and if there is another outbreak in 2021. In this case, because of the combined impact of an uncontrolled pandemic and another outbreak happening, the damage done is expected to be exponentially higher than either cases 1 or 2. The world GDP is expected to fall to -8%. -8%. Just to give some perspective, the 2008-2009 financial crisis only dropped the global real GDP to -0.1%. Both advanced and emerging economies are affected similarly in the first year of the pandemic, but emerging economies will be more greatly affected by the third scenario because of scarring effects of the damage done. And the summary ends on a darker note. If the markets get spooked by the amount of public debt out there, and so borrowing costs rise, it could prevent a lot of countries from providing income support to its people. And if that happens, the numbers here are optimistic at best. Which scenario do you guys think is the most likely among the three? Leave your thoughts in the comments below, and thanks for watching.